Portfolio Construction and Risk Management, Chapter 6, Portfolio Risk Metrics. Section 2, Beta. Beta tells us how sensitive an asset tends to be when the overall market moves. It's a measure of market-related risk, sometimes called systematic risk, which matters because it can't be diversified away. That's different from total volatility, which also includes company-specific ups and downs. A beta of 1 means the asset has tended to move roughly in step with the market. Above 1 suggests a more aggressive pattern. Below 1 suggests a more defensive one. And a negative beta means it has often moved in the opposite direction. So even before doing deeper analysis, beta gives you a quick read on market sensitivity. It helps to treat beta as a rough historical average, not a promise about what will happen in any single month. For example, a beta of 1-2 suggests the asset has tended to move about 20% more than the market, while 0-8 suggests a smaller response, and negative beta points the other way. If the market rose 10%, a 1-2 beta might imply about 12%, but actual results can easily differ. In a portfolio, beta helps you think about how much broad market exposure you're really taking on. Adding high beta holdings can make the portfolio more reactive to market swings, while low beta holdings can help dial that sensitivity down. Negative beta assets can sometimes offset risk, and beta also plays a central role in models like CAPM when estimating required return. Beta is calculated from historical returns for both the asset and a market benchmark. First, you choose a benchmark that truly matches the asset, then line up the return data over the same dates, measure how the asset and market move together, and divide that by how much the market itself varies. In short, beta is covariance with the market divided by market variance. What that formula is really doing is converting co-movement into a sensitivity measure. The numerator asks, how much does the stock move along with the market? While the denominator asks, how volatile is the market itself? So beta tells you the stock's movement relative to the size of typical market swings, based on historical averages. A worked example makes this more concrete. Using 60 months of monthly returns, TechCorp's covariance with the market is about 0.234, and the market variance is about 0.234, 0.0163, which gives a beta near 1, 50. That means TechCorp has historically been about 50% more sensitive to market moves than the benchmark. Compare that with two very different stocks measured against the same benchmark. Utility Co. comes in around 0.52, which suggests a defensive stock that tends to move less than the market, while FinTech Inc. is near 1.95, pointing to a much more aggressive profile. Same market reference, very different sensitivity. Once you have beta, you can use it for rough scenario estimates. If the market rises 12%, Utility Co. with a beta of 0.52 might be expected to rise about 2%, while FinTech Inc. with a beta of 195 might rise about 4%. The key word is might, because beta is a guide to historical sensitivity, not a forecast. Beta is useful, but it definitely has limits. It depends on past data, can behave differently in extreme markets, and it misses company-specific risk. So your benchmark choice and time window matter a lot. That's why investors usually pair beta with other measures like standard deviation and drawdown instead of relying on it alone.